Hi everybody, this is Ivan Alon, the founder and chief investment officer at Wayne, coming to you from Hong Kong today. Very rainy monsoon weather here in Hong Kong on this 16th of July. So today I wanted to talk about our most recent research highlight, which is published on both our US websites and Hong Kong website, which you can reach through the link in our profile. But it's about something that I think a lot of people don't necessarily understand, which is accounting. I myself am confounded sometimes by the complexity of accounting, and even a team member earlier today who has a concentration in accounting was reminding me how sometimes nonsensical accounting can be in terms of real world assessment of whether businesses are making money or whether businesses are losing money. And this is just the reality of accounting. And so this research highlight focuses particularly on this issue. And I encourage you to take a look at it and read it. It's not too long, it's fairly brief, but it cuts to the core of capital expenditures. And when businesses, like many of them right now, are making huge expenditures, particularly in infrastructure spending or AI spending, and when they do that, for these particular kind of capital expenditures, these expenses are being what is termed as capitalized, which means the expenses are not fully realized in the year in which the money is spent, or in the quarter in which it is spent. Instead, those expenses are capitalized over a period of time, 5 years, 7 years, maybe even 10 years, which means whatever that expense is, it's spread out over this very, very long period of time. And as time goes by, those expenses are then being taken and written onto the income statement. Well, what this does is when there are revenues without the corresponding expenses and money actually that was spent, truly spent out of the business, which does impact cash flow very, very negatively, but it does not impact earnings in that same way, because the income statement will treat these capitalized expenses in a much more generous way, giving them an amortization schedule, basically a depreciation schedule over a period of time. Well, what's so interesting is that the majority of this expenditure, which is happening in technology and AI and chips, lots of chips, these chips may not be having useful lives that are 5 years, 7 years, certainly not 10 years. And in fact, their useful life may be relegated more to something on the order of 3 years. Well, if the obsolescence time frame, the time at which you have very little useful life, or maybe even very little remainder value of an asset, is only 3 years, but you've capitalized it to 5, 7, 10 years, there's a big mismatch there. And so this mismatch is something that we focused on in our research highlight, and really view it as a troubling reality. And so as we go forward in time, if revenues are not continuing this parabolic move upward, which many of course believe that it will be, but history tells us from prior infrastructure build-out periods like the TMT of the late 90s, that in fact there is a plateauing and even a decline at some point, because ultimately the end consumer, which is businesses and households, don't have really what they're looking for. There's not a consumption element from applications of this technology that people really are consuming at scale. So unless revenues are continuing at this stratospheric pace higher, then at some point these capitalized expenses, which are going to be essentially an accelerated expense because you don't have 5 or 7 years, you only get 3 years before obsolescence, you get this acceleration write-off onto your income statement, which is a big, big weight on your bottom line, on your earnings, certainly your earnings per share. And like prior cycles before, this is exactly what we've seen and exactly what we witnessed is companies are then losing money technically on the income statement, even though they may not actually be losing money, but the income statement and the earnings per share show big negative numbers because of this accelerated depreciation that occurs at the point of obsolescence. So, we don't know why people aren't really talking about this more because, it's just kind of basic accounting. And basic accounting certainly can be very boring, but it's the absolute, bedrock of understanding stock prices and stock valuations. And, ultimately, a stock price is simply the present value of all its future expected earnings. And so if those earnings are going to be heavily impacted in the future based on a accelerated depreciation schedule, which seems highly likely given the experience everyone has had in technology. Just look at the rate at which Apple comes to market with iPhones and upgrades and technology in general, how quickly it does upgrade over a period of just a few years. So imagine that continues into the future, and these trillions of dollars that have been spent are in fact going to be written off in a timetable that is much more aggressive than I think many people are realizing will impact future earnings. But most people don't care about that because revenues are supposed to go parabolic here for the next several years apparently, and so we don't care about these accelerated depreciation schedules. But guess what? Some of us actually do care about these things and are responsible for managing money for clients. And as a result, we actually do make these risk assessments on a forward-looking basis. And we see this as a pretty real and big one. So that's all the time I wanted to take today to discuss something that's seemingly quite boring, but actually very, very exciting. And if you have any questions, don't hesitate to reach out to us at the contact information in our website. Thank you. Until next time.